He's here with TED spread. I love this. I love when you pick timely ones because it really brings together the LIBOR scandal, which we're all talking about, and of course the Federal Reserve.
Yep, exactly so. So the TED spread is something that people have looked at for years and years. Generations of B school students have looked at this thing as the measure of the health of the world economy and the liquidity that's in the banking system. So TED stands for Treasury Euro Dollar, which doesn't tell you very much, but what it compares is LIBOR, 3 months LIBOR, to the 3-month T-bill rate.
It's a credit indicator.
It's a great credit indicator because it tells you how much the Fed is spending to borrow money versus how much the commercial banks are.
Now, when we look at these types of levels, I mean, what level is so-called normal?
About half a point, 50 bips, is normal. So that's
means banks are lending to each other and they can borrow.
And it costs them about 50 bips more, half a percentage point more than it costs the Fed to borrow for the same time period. So half a point is normal-ish. 1 to 2 is you start to worry about it a little bit.
We're about 36 basis points right now.
Yeah, so
I mean, this is with all the central bank intervention, central banks coming in and making things easier.
And it's also, frankly, with the banks fixing the LIBOR rate, what they say it is. So yeah, so that's a nice, that's a normal rate that doesn't show any real stress in the system. During the crisis, that went to over 4. So 400 bips that would be.
And exactly, yeah. Explain why it happened. Just what type of scenarios caused it.
So when the credit crunch came, people got very frightened, right? And so it was very difficult for banks to borrow money, and that's why that part of it, the LIBOR, went up. Their cost of borrowing went up. At the same time, there was a flight to safety. Everybody was pouring money into U.S. Treasuries, so that cost went way down, and as a result, the spread between those two numbers got much bigger.
So what does it mean now with the revelations on LIBOR and the fixing and manipulation of the rate? I mean, can we trust the TED spread?
Exactly. And it really is a big problem. I think very seriously it's got some meaningful psychological impacts because this really is something that people always thought was sacrosanct. Even the Fed has looked at LIBOR spread and still looks at LIBOR spread in terms of figuring out whether they have to inject liquidity, what they need to do with rates. So the idea that LIBOR is maybe fixed, or at least certainly to some level it was fixed, and therefore the TED spread was inaccurate or is inaccurate, is really a disturbing idea to almost everyone on Wall Street.
Because you can't get a clear picture.
Exactly. You can't get a clear picture of what's going on. As long as the LIBOR is fixed the way it's fixed, which is just asking banks what they can borrow at instead of saying, what are you actually borrowing at? What do you say you can borrow at? And they can all sort of agree that they're going to put in a lower number than is real, which is exactly what happened in the crisis. The crisis was much worse than anybody realized in terms of interbank lending because they weren't telling the truth about how much it was really costing.
Well, right. And Fed Chief Ben Bernanke, taking questions on this today before the senators, did say that it's not like these banks were trying to profit. They were just trying to appear that they weren't as weak.
Right. Some cynics would say, and they were trying to profit, because if you're putting in the LIBOR number and also trading against it in your credit derivatives, it's easy to make money.
All right, you opened a whole can of worms, Bob Bryce, as always. But seriously, just another way that LIBOR influences a whole lot of rates and financial instruments, trillions.
Everything from student loans to your mortgage to your credit cards, everything.